All right. Hello, everybody. Welcome back into the NASDAQ Options Superstars program. I did want to get a video out here this weekend highlighting our open positions. Also take a look at the market big picture. What are we expecting going into next week? And also take a look at some potential new setups for early next week. Let's start out with big picture view of this market. Let's start out with a daily chart of SPY, which is the S&P 500 ETF. I don't use this chart to guide my entry and exit points, but it does help form my opinion on overall market environment. I use it to help determine whether I want to be aggressive with position size or more conservative. Do I want to use more weekly or monthly options? Do I want to use more long calls, long puts, or vertical spreads? All of that is guided by my overall outlook for the market based on the technicals. Well, if you take a look at this daily chart, you can see this move off of the lows back in March has been impressive, to say the least. We have gone from around 218.20-ish on the downside. We have recovered and moved all the way up to around the 306 to 307 range Thursday of last week. That has been an impressive move, a huge move. You don't see these but maybe a couple times in your career, right? And what's been impressive is that this has come in the face of some of the worst economic numbers that you will ever see. The unemployment numbers are extreme. The GDP numbers are awful. Any type of economic number or earnings number that we have seen come out, I mean, they have been awful, right? And this market continues to move to the upside. So what gives? I mean, what's causing this? It's because of all of the Fed policies. It's what the central banks are doing worldwide to prop this market up. It's masking all of this weakness. It's not sustainable long term, but when they're pumping trillions of dollars into the system, it's really, really difficult to trade off of fundamentals, to trade off of what's truly happening in this economy. You know, don't fight the Fed. You all hear that saying. I've been hearing it every single day now the last couple of weeks. The dangerous part about that is we've got a whole new group of traders coming into this industry because everybody's out of work and everybody's looking for ways to make money. And you've got this whole new group of people that just expects this market to move to the upside, move higher every single day, every single week. And when the boat gets loaded on one side, that's when the market likes to surprise everybody. And I think we're getting very close to one of those stretches. I'm not saying we're going to completely collapse and move back down to the lows, but I do think we will see a shakeout here in the very near future. We have got so many extremes on these charts right now. And some of the things that I'm seeing over the past couple of weeks is the market. We have seen the volume contract, number one. Okay, the volume is not anywhere near what we saw on the downside back in March. We have seen the internals deteriorate. We are not seeing the broad-based movement. This has not been a move to the upside where it's dragged along every sector, every stock, every index. It's very much been driven by a few cluster of names. You've got the tech names that have been super strong, then they take a pause for a couple of days, and the financials kick it in. You know, we just continue to get that rotation, and there's always one group that's strong enough to prevent any type of damage from being done on the downside. So what you want to fight the urge of doing here, and I know it's difficult because you see this market brush any type of bad news aside and just continue to move higher. The market is going to try to lull you to sleep here. And I can't stress that enough. I'm not saying you can't be bullish here. You can, just be cautious. This thing can turn in a hurry. So you want to be flexible. You want to take advantage of the flexibility that the options give us. And I'll walk you through more of that here in just a moment, and how I'm going to play that here over the next few weeks. From a technical perspective, some levels that I'm looking at for next week. We've got the high from Thursday. This high right here around the 306.50 range. That's going to be a very near-term area of resistance. Above that, we have got a swing level right around the 314 range. That would be the next area on the upside should we get another leg higher here going into the next couple of weeks. On the downside, if we start to get this thing to roll over, where would I be looking at for support? Well, we've got a whole cluster of moving averages, beginning with the 200-period moving average right around that, just below 300 would be a very strong area of support. So those are some levels that I'm watching big picture. But because this move has been so impressive on the upside, now is not the time to initiate a lot of new bullish trades, in my opinion. If you've already got bullish trades on and you want to, use some trailing stops, keep some positions on, going for the runners, that's fine. But initiating new long trades here, very tricky to do at these levels. And I'll show you some individual charts, and I'll show you why that is from a statistical point of view. The VIX, What's been interesting too is that the VIX continues to stay elevated. We still have a VIX up above 27. That's even after this massive move off of the lows. There's still a lot of uncertainty out there because of what's happened. Because of what's happened with the virus and with so many people out of work and these economics numbers being awful, there's still uncertainty there. Then you add in what happened here over the weekend all across the country with the protests and the rioting. I mean, it's an awful situation. I'm not going to get into the why and the political side of that. That's not the time and place here in this video. But it just goes to show that there's a lot of unrest out there. There's a lot of people that are not happy with what's going on, whether it be economically, whether it be socially. I mean, it's a world that has a lot of people on edge. Let's put it that way, and rightfully so. But none of that seems to be pricing into this market, and I want to see what happens next week, right? Because the market so far has brushed everything aside, but we are at levels now, guys, where in the near term we are at extremes that you do not see all that often. And I could very well see a shakeout coming in the next week or two. So how does that play into our favor? Well, we'll talk about some of our open positions, how we plan on managing those, what we're looking for, and then we'll take a look at some new charts for next week as well. So again, some of the key levels on the upside, we just talked about those. On the downside, some key levels of support. We'll want to watch those closely into next week. But because of this move off of the lows and how extreme we are, I want to be cautious here on the upside. So let's go ahead and bring up the position sheet. For those of you that are newer, I update these position sheets every morning before the market opens to highlight our open positions. I separate them by trade type. So down at the bottom, you will see different tabs down here. And I separate them by trade type just to make it easier for you to see what we have on. What bullish, what bearish trades on, what spreads, what long calls, long puts. Instead of having one big long list, I like to separate them just so it's easier to find what you're looking for. And no surprise, I mean, you guys have been tracking the trades here over the past couple of weeks. I mean, we've got a number of neutral to bearish trades on. We've got a lot of short call spreads on. And I'll walk you through some of those chart patterns here in just a moment and walk you through why we have those positions on. But the key to point out here, a couple things. I will always break it down by the symbol that we're trading, the date that we put the position on, the position type, the actual position, and that position states what expiration cycle we're using, what strike prices we have on, our entry price, our position size, and that position size reflects risking $500 per trade. That's why we list the different position size numbers there. We give our target levels. So if you want to set up closing orders ahead of time, that's fine. You always know what we're looking at here ahead of time. We'll give the cost per trade, and then we'll break it down with some details, with some additional details on the trades that we do have on. Now, with these short call spreads, the key number here is the first strike price listed. So on QQQ, 232, eBay, 43, CrowdStrike, 82.5. Those first numbers there represent the strike prices of the options that we sold. That is the number that we need price action to stay below. As long as price action stays below that first strike, we're okay. We can make money. Even if it only stays below that level by a penny, we're okay. The only move that hurts us is a big directional move above that short strike. Okay, now let's drag this over to our other monitor. So let's go over and let's talk through the charts and break these trades down in more detail. QQQ, this is the NASDAQ ETF. Those of you that have been longtime members, you know that we've had a QQQ position on here for the last couple of months. I mean, we've been selling call spreads here, and this market has not cooperated at all. And price action just continues to move to the upside. I don't typically like to roll positions multiple times like we've done here on QQQ. It's very rare that I will do what we did last week and closing out of another position and rolling it out farther in time like we did on QQQ. But it's because this market is at such an extreme. Look at the pulse indicator down at the bottom. We've got all of these yellow bars here over the past week and a half. What do those represent? They represent price action being between a 1 and a 2 standard deviation channel move on the upside. Okay, when you start to approach a 2 standard deviation move on the upside, it doesn't mean that price action can't continue to move higher. It just means it's not statistically probable that it'll move to the upside. All right, so everything that I do is numbers based. It's based on the percentages. And I'm just going to bring a quick screenshot over to show you the bell curve, which highlights the standard deviation levels that I'm talking about. So when I start to talk about price action being between a 1 and a 2 standard deviation move, which it is on QQQ, we're out in this range here. You start to see a 1 standard deviation move on the upside, 13.6% of all occurrences. When you start to hit a 2 standard deviation move on the upside, that only represents 2.1% of all occurrences. What does that mean? Well, if you take a look at the move to the upside, it's been impressive. If I were to place a new bullish trade here, I'm basically banking on that move to the upside continuing. But when you take a look, only 13.6% of all occurrences fall above that range on the upside. The numbers don't favor that move happening. Okay, the numbers favor that price getting back into this middle section. This middle section here, I know it's kind of hard to see because of that play button that's in the screen. I just wanted to get a quick screenshot up. But basically, 68.2% of all occurrences fall inside of this middle dark box on the bell curve. What I am banking on is that because we're up in here, price-wise, I'm banking on us starting to gravitate back down towards that midline. All right, so taking that over to the actual stock chart again, I am basically banking on price action either starting to consolidate here, starting to chop sideways, or even reversing to the downside. That does not mean I'm expecting this thing to collapse. We don't need it to. I need price action on QQQ to stay below our short strike, which is at 232. So I need about a $1.30 sell-off. That can happen in a matter of an hour. I mean, it's in this market with the VIX elevated, you can see those moves happen very, very quickly. So we are still short the call spread. We have this position on with the June 19 options. And let me jump over to the trade page. Let's talk through that here a second. The June 19 options, those are the ones that have 19 days left to expiration. What's going to happen from this point forward? With these options that have less than 20 days left to expiration, the time decay really starts to escalate here. It's going to start to really pick up in our favor. When you're short a call spread like this, every day that passes, that helps us, right? The time decay is going to help us. The options are also going to become more sensitive to changes in stock price. Any type of move to the downside here over the next week or so is going to be reflected quicker in the prices of the options. So that's going to help us recover much faster. That's why I'm willing to hold the credit spreads longer. They tend to recover much faster. All right, so no reason to close out of the QQQ position. We'll continue to hold. We still have 19 days left here to expiration. So definitely want to see a pullback sooner rather than later, but we'll continue to hold that one as is. Let's go over to eBay. You can take a look here at eBay. We are shorts the 43.45 call spread out in the June 19 option. So again, the ones with 19 days left. Now, what's happened here on eBay? It's one of those stocks. If I zoom out here, I mean, take a look at this move from the low back in March at 26. We've gone all the way up to 45. This thing has almost doubled here in a matter of just a few months. That's an extreme move. No surprise that we are seeing an overbought condition on the pulse indicator. Those yellow bars represent price being between a 1 and a 2 standard deviation move on the upside. Again, it does not mean price action has to reverse immediately. It could continue to move higher, but only 13.6% of all occurrences fall outside of this range on the upside. The odds favor either a period of consolidation or a reversal to the downside. Now, what do we need to have happen here? We need price action back down towards 43. I need about a $2.50 sell-off on the downside. Now, we're very overbought. This thing can turn in a hurry, sooner rather than later, but this thing, that because the time decay continues to help us, if this price action does turn here over the next week or two, it can recover a lot faster for us. That's why we continue to hold the position. I'm not saying this is going to turn into a full winner. We'll just have to wait and see what happens price-wise. But with a credit spread, because they can recover much faster, because we've got 5 ways of making money on the position, we will continue to hold here. The nice part about the spreads is we know that we're in a risk-defined trade. On eBay, I cannot lose more than $129 per spread. That's my max loss on the trade, regardless of what happens. If price action does not pull back, the most I'm out is $129. So that's why we continue to hold the position on eBay as well. CrowdStrike, CRWD. This has been another one. I mean, some of these tech names, guys, I mean, it has just been absolutely impressive on the upside. I mean, it's hard to find any type of weakness for more than a couple hours at a time. CrowdStrike, we are currently short the 82.5, 85 call spread in the June monthly options. So we got 19 days left to expiration. This one does have earnings upcoming. If I jump over to the Market Watch tab, we'll take a look here. We have earnings coming up here this week on June 2. So this could be a trade here come tomorrow afternoon. We may end up closing it out. We'll reevaluate. I'll certainly let you know what we're going to do in front of earnings. I wouldn't be opposed to holding through earnings just to see, do we get a move to the downside? Do we get a reversal lower? We're overbought, certainly. So we'll let you know. But right now, if we were to hold, I would need price action back below 82.5. We would need about a $5 sell-off. I mean, this thing was up over 10% on Friday's session. It was just a huge move to the upside. So we'll keep a close eye on this one. We'll let you know what we do in front of earnings. The tricky part about a lot of these guys is that we put these trades on initially because these markets were overbought, and they just continue to get more overbought. So I definitely want to hold these, but the earnings numbers on CrowdStrike definitely throwing us a little bit of a curveball. So I'll let you know what we do here on Monday, whether we're going to hold through earnings or whether we will go ahead and close it out. Microsoft. This is another position that we have on with the June 19 options. We are short the 185, 187.5 call spread. If I zoom out here, you'll see that price action has certainly started to get choppy here. We haven't seen any type of significant selling yet, but we have definitely started to see some consolidation. And if we do get some market-wide selling over the next week or so, I could certainly see this thing moving to the downside. Now, the neat part about this is right now, we have not seen, we sold the call spread initially back on May 19th. Looking for a move to the downside, we have not had that move yet, but we're still okay. We need price action to stay below 185. It has so far. We haven't seen the move that we've wanted so far, but we're still okay. If we get any type of move to the downside over the next week or so, this thing should really start to come in for us. All right, so we'll continue to hold the Microsoft position. As long as we stay below 185, we're okay. PayPal. And this is another short call spread that we have on. This one actually expires at the end of this coming week. So this is one that we definitely have to watch closely. We definitely need a pullback as well on PayPal. So this is another one that, I mean, you can see on the chart, it's been just a one-way shot to the upside. We have had an overbought condition now for the last month or so on the pulse. We have all those yellow bars on the pulse indicator. Right now, we're short the 148, 150 call spread. We need about a $7 move to the downside. I mean, we need a decent move to the downside in this coming week. Right now, not looking great, but we'll see if we can get, I mean, this market's so overbought, we can see this thing turn in a blink of an eye. But Friday session, we closed up 4%. Obviously, didn't help us out. So let's see what happens here. Definitely need a reversal in the early part of the week. When I see a position like this where you start to get into expiration week and the move has gone against us, I don't just immediately close the position out. A lot of people will ask, do we have assignment risk here? We do, but you don't typically see early assignment until the last couple of days before expiration. So come Wednesday of this coming week, if we don't get any type of a move to the downside, if we are still seeing this thing just move higher, higher, higher every day, we would go ahead and close it out before the close of the session on Wednesday. That way we can avoid any assignment risk. Now, I had some questions come up in Slack. Do we need to worry about assignment? We don't. In the big picture, we don't, because we're in a risk-defined trade. We're short the 148 call, but we also own the 150 call. We have that there as protection. Even if we do get assigned, you know what your maximum loss is up front before you ever put the trade on. So it's not the end of the world if you get assigned. It's just an extra step. It's an added step that I like to try to avoid because a lot of retail traders get so stressed out because of assignment. They think they've got large loss potential there. You don't. You're in a risk-defined trade. But just to try to avoid that whole scenario, I tend to just close them out. Close trades out before expiration. Just avoid the whole assignment situation and move on to the next trade. So we saw the PayPal position on. The clock is ticking on this one for sure. Come open tomorrow or Tuesday, definitely need to see a reversal pretty quickly here on PayPal. Shop. This is symbol SHOP. So on Shopify right now, we are short the 815, 820 call spread. This is one that we tried to close out here last week. We couldn't get filled on this one. So I had some questions on this. Because on this move to the downside last week, it was on this move, what was that, Wednesday morning, I believe, when we sent out the closing alert initially. We were on the lows. Markets were getting beat up, and we were inside of our profit range. So I sent out the closing alert. The problem was we couldn't get filled before the market reversed almost immediately. So if you still got the position on, I've had questions from people asking, do I keep the position on or do I just mark it out? With a credit spread, you do have the ability to hold and be more patient because the time decay is helping you. It's not a good feeling to watch the market reverse and go from your target range, back outside of that range. It's not fun to see that happen, but it's important to stay patient. Right? I'm not saying we want to let this thing go from a winner to a loser, but give it some time here. The market is still overbought. We've already talked about that at length here. I still like a deeper pullback. So I would continue to hold. Our target range on Shop, we're looking to buy it back for between 46 and 92 cents. And let's see where it's trading here as of the closed Friday. Let me pull up the trade here and we'll price it out so you know what we're looking at for Monday's session. So we're short the 815, 820 call spread. And it's a little funky here because the markets get so wide going into the close. They will widen out the bid-ask spread, so your P&L is going to look a little funky. But this one, it's actually trading for $1.55. It's actually trading, the true price is going to be much lower than that. It's just because they widen out the markets right at the end of the day on Friday. We are looking to close this thing out for between 46 and 92 cents. If you wanted to create your closing order now at 46 cents, that would be if you 75% of your max profit and keep that closing order working. So that way going into next week, if we can get filled in that range, great. You can get that order filled. You don't have to sit there and be staring at the charts, staring at your orders all day. Just let the order work. So we continue to hold Shop. As long as it stays below 815, the price is at 757. So we've got a nice little cushion on the upside. As long as we stay below 815, we're okay. And this one expires in 19 days. It expires on June 19. So I don't have a problem if you still have your closing order on and you still have your open position on. That's fine. We'll continue to keep the order working and see what happens here going into next week. The last short call spread that we have on is on Spotify, and this has been just a truly impressive name, no doubt about it. So on Spotify, we are currently short the June 12 weekly cycle. We're short the 197.5 200 call spread. Now, if you take a look here, the pulse indicator not only went yellow, it also went green. And when it goes green, like it does here, that represents price action being between a 2 and a 3 standard deviation move to the upside. Less than 2% of all occurrences will fall outside of this range on the upside. That's why notice what's happened since we started to see those green bars plot. Price action hit the extreme. We haven't seen a huge pullback, but see how price action started to consolidate, has started to reverse to the downside. That's a very typical pattern off of an overbought condition on the pulse. So this one right now, again, we're short the 197.5 200 call spread. We need price action to stay below 197.5. So it's very clearly below that level. We've got about a $17 cushion now above us. So a lot to like about this trade. We're targeting between 22 and 45 cents. And when I say we're targeting that, I'm grabbing it right off of our position sheet here. Anytime that I post those target levels, I always start out with my closing orders at that lower number. So on Spotify, my closing order is at 22 cents. I'm going to wait and see if we can hit that 75% of max profit level. And that's if we can get any type of a move to the downside in the coming week, we should be able to close this thing out in that target range. So on all of the short call spreads, all of them would benefit from a move to the downside next week, certainly. So with this market so overbought, it's really tempting to just say, okay, screw it. Let's close out of these positions. Let's just go all in bullish. But like I said earlier, guys, you have to focus on the statistical side of things. You can't just sit there and we're in an extreme move, right? We're in a historic move right now. You can't sit there and change your approach and say, hey, this is the new normal. This is all we're going to see going forward. So this is how I'm going to trade it. You have to base your numbers off the statistical side of things. And right now we're at an extreme that is due for a pause or a reversal. And that's why we continue to position ourselves for a more of a neutral to bearish outlook. And we're going to continue to look for those opportunities here in the next week or two. And then our last new position from last week was on symbol ASHR. This is Asher. We went ahead and we bought the long puts, and here's why we bought the long puts. Our sentiment indicator down at the bottom, it's the green and the red histogram down at the bottom. We flipped from green to red, meaning we went from bullish to bearish sentiment being in control. That's what gave me the first step in the short sequence. I wanted to wait for my moving averages up above to confirm that red and blue moving average. That's the 8-period exponential moving average. I wanted price action to get below that level, which it did. And we did get price action to touch our entry point, which is our pink dots there on the chart. So we came in last week. We bought the July 17, 27 puts. This is a bearish position. Absolutely want to see this thing move to the downside. This is more of an aggressive bearish position. This is not a trade that, we can stay patient on for weeks at a time. We need this thing to move lower relatively quickly. So we'll see if we can get that move to the downside. There's some tension with China starting to escalate again as of end of last week. We'll see if that starts to play into what we see here in the U.S. with some of these equities that we talked about. So Asher giving us some exposure to some of those China tensions. Definitely like the move to the downside. We bought those put options for $1.03, $103 a contract. We're targeting $2.06. Our stop level is at 51 cents. And I'm just grabbing those numbers right off the position sheet from the owner site. So some things that I'm looking at for next week before I wrap up. If you start to go through this list, there are so many overbought markets, guys. You start to go through the tech sector. There are names that are at pretty strong extremes. I'm not saying it's going to be across the board on every name, but it's pretty darn close. You take a look at Apple. Okay, we've got an extreme overbought condition here, showing some signs of getting tired. The pulse indicator is clearly yellow. Look what's happened to price since that pulse indicator went yellow. See how price has started to slow down here, started to consolidate, even showed some signs of reversing here end of last week. We'll see if that starts to play out next week, start to see a deeper pullback there. You take a look at some of the other names in the NASDAQ. Monster Energy, very overbought market here. Very overdone. Pulse indicator, very clearly yellow. Definitely looking for a reversal there going into next week. Adobe. Another one. Some of these tech names, it's hard to find a downtick in some of these charts. So these are some of the names that I'm looking at here. Again, I'm not really interested in initiating new bullish trades in the near term. More than willing. If we start to get, let's just say we get a day or two of selling. You start to test some of the support levels, more than willing to consider some new bullish trades. But chasing at these levels, no, I definitely want to see a pause or a pullback before we initiate new bullish trades there. So that's the plan of attack to start the week. Still want to be neutral to bearish here in the near term. And then if we do get that pullback, that could reset things, and we could certainly consider the upside again. So if you have any questions on any of our open positions, you can always ask inside of Slack. You can always contact me directly. More than willing to help out. And then we'll see if we can get our typical 3 to 5 new trades on next week. We'll just wait and see what the market gives us. So enjoy the rest of your weekend, everybody. I'll be back with you guys on Monday with our next round of updates, and we'll talk to you then.